Welcome to this Killick Explains video, and welcome to video 4 in my 4-part series on fund basics. Now, as a reminder, video 1 was all about what is a fund, video 2, what is a unit trust, video 3, what is an investment trust company. So this is video 4 and the last one on exchange traded funds. Last but by no means least. Now, what are the key features of these exchange traded funds, or ETFs as they're often called? Well, the simplest way to understand what this actually is to think about it as an exchange traded unit trust. And that'll make more sense if you've watched the previous 2 videos. So as an investor, you buy shares, not units. And those shares trade in an open market on exchange, London Stock Exchange for example, and they're fully tradable throughout the trading day. They can be bought and sold as normal, subject to the liquidity on shares as you'd expect. They may pay an income or they may not, and the valuation of your shares is linked to the value of the fund, the so-called NAV. So that's where the unit trust aspect comes in. You don't get discounts and premiums to underlying net asset value as you would with, say, an investment trust company. In other words, when it comes to pricing, the market sets the price. There is no premium or discount, and it's continuous. All right, you can get a price all day. Now, these things come with costs. Although they are potentially quite cheap in some ways, which I'll come back to, there are costs to consider. You're buying a share, so you'll pay stamp duty. There are usually bid to offer spreads, although they can be pretty narrow on highly liquid exchange traded funds. There are commissions, and then the one people sometimes forget is the platform fees, and you need to weigh all of that up before rushing to the conclusion that the whole thing is cheap. The headline commission rate may look enticing, but the overall cost of buying, holding and selling these things may comprise several other components. Now, exchange traded funds are passive, and this opens up a debate about active versus passive investment management. In other words, passive instruments, and a lot of ETFs are passive, are designed to simply mechanically follow an index, an asset class, a basket of shares, or a particular strategy. High yielding shares, for example, dividend aristocrats. So fans of these passive strategies like them for being simple to understand, cheap, quick, and there's lots of variety. There are thousands of these things out there. But that in turn throws out a few complications, if you like, a few kind of things to weigh up on the flip side. First of all, if you are passively following an index, for example, the best you'll ever do is match its performance. You won't beat it. Costs can add up. The enormous choice can make it quite difficult to whittle down what you actually want to buy. And the fact with an app you can simply push a button to buy and sell them can make it a little bit too straightforward for people to buy and sell ETFs, and that can encourage market timing, which is something I wouldn't encourage people to do. And if you're looking for something in a particular niche, you might struggle to find it with an exchange traded fund because it might advertise itself as being an emerging market fund with a specialization, but actually when you look under the bonnet, what it's actually holding is a fairly broad brushed index containing some big household names. So active managers can often go to the places where ETFs can't necessarily get into. So I tend to use exchange traded funds in liquid, well-known markets, S&P 500 for example, and I'll tend to use more specialist, perhaps actively managed funds in areas where I don't feel as confident I can get what I need. So where are these things most useful? I would say liquid, open markets, perhaps a bit less so where there is a niche requirement. Now, that's a lot of information covered, not every angle of exchange traded funds. So to find out more, my comprehensive library is killick.com/learn. To read more about how to invest in funds and portfolios and so on, then it's the guide next to me, which is editor@killick.com. That's called How to Invest in Equities, I suppose not surprisingly. And for a copy of Confidant, which contains some of this stuff in a kind of commercial context, again, editor@killick.com.